You're making more money than you ever have, but you've never been more confused about how to invest those dollars. After all, it is confusing, all the options. Bitcoin, stocks, bonds, fine art, rental real estate, private equity, venture capital, all these different options that are available to you can be really confusing. Well, today we're gonna break through that noise and simplify the complex topic of investing for beginners. We're gonna break this video down into 3 parts. They're timestamped below if you want to jump around. Part 1, the basics of investing. Part 2, how to invest these first initial dollars. In part 3, common questions I get as a financial advisor to multi-millionaires. So let's go ahead and dive into the video. Number 1, the basics of investing. So when we think about the basics of investing, first let's think about the foundational reason why we invest money. The reason why we invest money is to hopefully make more money. That's the whole reason why we would give somebody or something like a company our money. The whole goal is that they are going to take that money and they are going to increase the value of it. Well, when we look at this, there's a couple of fundamental problems that we need to be really mindful of whenever we are investing money. The first is a gallon of milk. And you might be thinking, what do you mean a gallon of milk? Well, back in 1930, a gallon of milk cost 30 cents. And today, that same gallon of milk costs $4.30. So that fundamental problem we're talking about here is something called inflation, where over the course of time, our buying power is going to get decreased if we are not making a high enough rate of return to outpace inflation. That's the first problem we need to be mindful of. The second problem is the casino. And you're probably thinking, oh, we're talking about investing, not gambling. Well, we are. But the casino is a great example because when we think about the casino, there's a high probability that the longer you stay in the casino is going to win. And the way that we think about investing is the complete opposite of the casino. We want to put ourselves in a position that the longer we stay in the game, the higher our probability of outpacing that gallon of milk or inflation. So how do we actually do that? And how do we actually combat the inflationary pressures that we feel in the market? Well, first it's understanding how do we actually make money in any investment. And typically there's 2 ways that you can make money in any investment that you have. The first is going to be income, and the second is going to be capital appreciation. Think about income as the payment that you're going to receive for a business that you own. So let's take a business as an example. If we look at a business today, typically what happens is over the course of time, that business is going to make money. So let's say in 2024, that business makes $1 million and you own 1% of that business. That means that you have the right to $10,000 of that profit. And that is going to be the income component to any investment that we make. The profits of the business get distributed out to the owners of the company. The second component is going to be capital appreciation. And capital appreciation only gets realized when we actually sell a company or sell a business. So in this same example, let's say you own a company, you're making $1 million a year, and that company is worth $4 million. Well, let's say next year that company makes $2 million a year in profit. The value of that business probably went up from, call it $4 million to $10 million in value, okay? That appreciation from 4 to 10 million is going to be what we call that capital appreciation sleeve. And when we combine those 2 things together, that's going to give us the rate of return we have and how we actually make money. So now that we're thinking about these basics of investing, what are some of the asset classes we could invest in? Okay, and an asset class in its purest form are going to be different ways that we can take money and we can buy things with it. Okay, that we're hoping are going to pay us more money in the future. This could be everything from buying a piece of art to buying a stock, buying a piece of real estate, all these different avenues we have to invest money. But what should you be investing in as a beginner? Well, today what we're going to focus on is the stock component. Okay, this is the easiest way for you to get started in investing money. It requires the lowest amount of money, and frankly, it is the easiest way to get in the game from an investing perspective. But even investing in stocks can still be really confusing. So let's dive into the second part of this video, what we should be investing in. And let's specifically look at stocks. Number 2, what to invest in. So now that we understand the basics of investing, what should you as a beginner be investing in? And again, our main focus here is going to be looking at stocks, but specifically, how do we invest in those stocks? So there's a couple of different ways that we could do this. We could go out and buy a bunch of individual stocks that we like. We could say, well, I got my Apple iPhone here. Maybe I'll go out and buy some Apple stock, or an Amazon package showed up on your doorstep. I'll go out and buy some Amazon stock. Or maybe you watch Netflix at night. I'll buy some Netflix stock because I utilize those companies. What we have found is that over long periods in time, stock picking is a losing game. Doesn't mean that there aren't people that have gone out there and made that happen. But if we are looking at the amount of risk you're taking on with the amount of reward you're expecting, stock picking is typically a losing game. So let's go ahead and avoid that and throw that out. Let's look at our second option. Our second option is, well, if we can't buy the stocks that are going to be all winners, what should we invest in? Typically, for beginners, we see a great option being something called index funds. And the largest index and the easiest one for us to look at would be the S&P 500. The S&P 500 is made up of the 500 largest companies in the United States. And it's a way for you to buy one position that's going to encompass all 500 of those companies. Okay, so if you're a beginner and you're looking to invest money, an index fund can be a great route. Because when we think about investing as a whole, we really want to break it down into how much risk are we taking and what is our certainty of us making money. Because remember, again, our whole goal in investing money is that we're going to make money. And for beginners, the most important thing is, how do we increase the certainty that we're actually going to make money? So let's look at this graph that I think does a great job depicting the amount of risk and the amount of uncertainty. So we have two bars that we're looking at here. Bar 1 is looking at the time frame, and then bar 2 is looking at our probability of success. Okay, so when we look at our timeline over here, what we can see is that the lower the time frame, or the longer or the shorter the amount of time that we're going to actually invest, the lower our probability that we are going to get a high expected rate of return. But as we go further out from a timeline perspective, and the longer we're planning on sticking with our investment, the higher our probability that we are going to get a positive rate of return that, again, is going to accomplish our goal, which is outpacing inflation. I think this is a really important thing to consider when you are a beginner and you're investing in stocks, because your first knee-jerk reaction when there's the first dip in the market is going to be, well, should I sell? What should I do? And the reality is there's probably nothing you should do. If anything, if the sale's on store, you should just go out and buy more of the store. So in this case, buy more of the S&P 500. But the biggest problem I see with investors who are just starting out is that they panic. And they panic in a way that they sell what they own and they decide to sit in cash. And by sitting in cash, they think that it's going to make them feel better. And in the short term, it might make them feel better. But it's going to give them a much lower probability that they're going to get that goal or that outcome, which is the money that they're investing is going to make them more money. If you don't hear anything else from me on this slide, hear this. The longer we stay in the game, the higher the probability that we are going to make money in stocks. So that's the first thing to understand on why we're investing in stocks. The second piece is, again, how do we actually make money in stocks? And to break this down one more time, there's really two components. There's our income component, which is called a dividend when we buy a stock. And then there's our capital appreciation, which is the actual stock price. So if we look at an example here, let's say Apple stock. Okay, if we rewind the clock 5 years ago, and we're specifically talking about the stock price, Apple stock price was worth about $70 per share. But today, Apple stock is worth over $220 per share. So for every one share that you bought, let's say it was $69, that $69 is now worth $225. Okay, that's capital appreciation. The second component is income. So today, Apple pays a 25 cents per share per quarter dividend. So for every one share that you own, you're going to get a new income source of 25 cents per quarter per share that you own. Okay, so if we combine those two things together, that's going to be what our rate of return actually is. So when we think about investing for beginners, I would start with index funds. Index funds are a great way for us to get exposure, dip our toe in the water, and be in a position that we can get that outcome of us actually making money. The third thing we need to talk about is the common questions, concerns we get from investors. And I can tell you firsthand, this is the number one thing that we see get thrown out there from investors that are first investing into stocks. And it's the difference between uncertainty and risk. So let's look at this illustration to outline the difference between uncertainty and risk. Okay, when we think about risk is something that you are knowingly taking on. Let's take the example of driving your car around. You're taking on a risk that you're going to be in a car accident. If you're in a car accident, you have insurance that you purchased to protect against that risk. Whereas uncertainty is something that you don't know is going to happen. Nobody knew that COVID was going to happen and the market was going to go plummet by 40% in less than 6 months. That is uncertainty. And that is the number one thing that investors want to protect against. But how do we protect against something that we don't know is going to happen, that is uncertain? And COVID, again, is a perfect example, because if you looked at somebody who invested at the very peak of COVID, right before COVID happened, you would think they're the worst investor in the world. They invested right before COVID, market drops 40%. Well, the market popped back up 40% or 80% to get back to where it was at almost 18 months later. And from an outcome perspective, that client still got the outcome that they wanted, which was they took a dollar that they invested, and now they're in a much better financial position because that investment earned them more money. Okay, so the key here, the key question that we get asked is, how do I plan for that uncertainty? And I really just encourage you to break it down on those two components: uncertainty versus risk, and making sure that you do not combine the two of those together. The longer you're invested in the market, the higher the probability that you're going to get a good rate of return with the lowest amount of risk. So if you enjoyed this video, check out in the description below another video we made around investing for business owners. If you haven't already, subscribe to the channel for more videos just like this one.